So, folks, we're going to do a quick one on how to evaluate a stock. And technically, there are three things that you should look at while you're evaluating a stock. So, the first one is called PE ratio. So, PE ratio is the price to earnings ratio. Um, this should always be in the range of 15, and price is the stock market price, whatever you get, and earnings is the reported earnings, which is the revenue of the company. So you simply take the price and you divide it by the revenue of the company, and you'll get this particular number. This number should always be in the range of 15. There are companies which will have it more than 15, but those are considered to be fairly valued or overvalued in sense. Okay. Second one is called PB ratio, or price to book ratio, and this should be always in the range of 1 to 3. Price to book ratio is there is a book value of a company and there is a price of the stock. So the stock which is trading at should always be at the book value of the company ideally, or it should be 3 times the book value. In Indian scenario, it could be even 4 or 5 times, but typically the range is between 1 to 3. So if your stock is moving beyond 1 to 3, then you should be careful of buying that stock. It could be a frothy or a overvalued stock. The final one I would want to look at is the PEG ratio. The first two ratios are quite common, but this is a little uncommon ratio, but it's picking up. PEG ratio is basically price to growth earnings ratio. So you look at the growth earnings of a company over the last 5 years, and then you calculate what is the growth there. So let's say the earnings was X, and the company grew by 10% in 1 year, and the next year it grew by 15%, and then it grew by 20%. So you take the overall average of that 5-year growth percentage, so it's 10 plus 15 plus 20 plus XYZ, whatever that number is, divided by 5, then you'll get a percentage. So that percentage you divide it by the price of the stock. So this value should always be less than 1 because that shows a good value of the company. So these are some of the 3 important criteria that you should look at while you're buying a stock. And this is one of the most famous quotes from Charlie Munger, who is a partner of Warren Buffett. He says that it's far better to buy a company, buy a wonderful company at a fair price than a fair company at a wonderful price. So what it basically says is that you should always weigh the price of the company when you're buying the stock, and once you have weighed the price of a company, then only you should buy it. Even if a company is very good and it is priced very high, you should be careful about buying that company. So these 3 parameters will give you a fairly good understanding. Now I want to take you to a site where you'd be able to sort of get an understanding of these ratios. So let's get into that site now. So the site is called Value Research, and it's a very good site. It tells you good values of companies. So let's say I want to value a company. So I write the value of name of the company and I say search. So it will give me all the data which is related to the company. So it will tell me the data in terms of the price to book ratio. This is the price to book ratio. This is the price to earnings ratio. So look at this company. Its price to earnings ratio is 14.28. So we spoke about 15. So this is fairly priced company. Price to book ratio is 1.6, and we said that it should be in the range of 1 to 3. So this is fairly priced company. This is return on equity. It varies from companies and companies. This is net margin. What is the margin in that particular area? What's the profit this company has made? These are things which are very common. You always look at revenue and profit and market cap of the company before investing, but these are kind of critical factors which determine company A to company B. So if in the same sector, let's say this is the same sector and you want to look at peer comparison. So these are 3 companies that we are looking at, and clearly they are in the same sector and their price to book ratio is similar. The price to earnings ratio is different. So you look at this company, its price to earnings ratio is 172. So clearly this company is quite overvalued, and I would never invest in a company which is overvalued to such an extent. So this kind of gives you a fairly decent idea of the company, its growth prospects. Of course, you should always also look at the annual ratios, like what is the revenue of the company, what is the net profit, earnings per share, the book value of the company, so on and so forth. So these are also decent measures of understanding a company. And finally, you should also get a sense of the management, the sector that company is in, before investing in the company. So I hope you understood a fairly high level of stock markets, and this is how investment of stock market is typically done. You look at the set of ratios, and then you look at the sector, then you look at the management, and you form an opinion, and then you invest in that stock. So this gives us a fairly good understanding of the stock. So once you have understood the stock, the price to earnings ratio, the book value of the company, all of these things, and you've also compared the ratios, then you look at the stock market, and here you get a sense of how the company has performed over the last 6 months to 1 year, and 5 years kind of a journey. And so if I click in this particular company, it's called Moil. It's a magnesium manufacturing company. Magnesium is an input to coal, so if it will do well if it's an infrastructure space. So let's look at the price earnings ratio, and we have looked at the price earnings ratio. It's decent company. The final thing you have to look at is the company good at the price that it's offering right now. So if you look at the chart, you will clearly see that the company has had a high of 416. So here is the values that you can see. So 416, and now it's trading at 327. So this means that the company is right now trading at a lower value. So it was trading at 214 at the beginning of this year. So you have to enter the company at some price point. So you basically have to enter in a lower zone, and you have to exit in a higher zone. So never exit enter the company in a higher zone, because the chances of going it even further is less. It's something called as the margin of safety, which Warren Buffett speaks about a lot. He says that always buy when there is enough margin of safety. So always buy low and sell high, and don't sort of buy anywhere in this range. Always buy in this range. So if you come to a fairly low range for this company, look at the sort of growth that company has had, and you buy it at that value and then exit. That will be a good stock market strategy for you to operate. So with that, I'll sort of come back to my original pretext. Let's go back to it, and what we spoke about, let's just evaluate that one more time. So first is price to earnings ratio, should be less than 15. Second is price to book ratio, should be between 1 and 3. And third one is called PEG ratio, which is price to growth earnings, and it should be less than 1. So this is a fairly high level understanding. Hope you liked it. Thank you very much. Have a great day.